Before we dive in, please remember that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information provided is not a substitute for professional financial advice. Always consult with a qualified professional, like a certified financial planner or mortgage broker, before making any major financial decisions related to a home loan. The average American homeowner will overpay by more than $64,000 on their mortgage. $64,000. That's a new car, a college fund, the vacation of a lifetime, gone. And the reason why is a single tiny mistake they make before they even start looking at houses. They treat an interest rate like it's the weather. They think it's something that just happens to them, a number handed down from the financial gods that they have no control over. And that single belief, that one misconception, is costing families a fortune. Imagine two neighbors, the Smiths and the Garcias. They buy identical houses on the same street for the exact same price. Both families have similar jobs, similar credit scores, similar savings. But the Smiths got a mortgage rate of 6.5%, and the Garcias, using the exact system I'm about to lay out for you, got a rate of 5.75%. That difference sounds tiny, right? Less than 1%. It seems insignificant. But over 30 years on a $400,000 loan, that tiny difference means the Garcias will pay $56,000 less than the Smiths. $56,000 back in their pocket. They'll build equity faster. They'll have more financial freedom. They'll own their home free and clear years sooner. The only difference was knowledge. This video is that knowledge. This is your playbook. We are going to completely demystify the process of getting a home loan. I'm not going to give you the same tired, generic advice like, check your credit report. You already know that. I'm going to give you the step-by-step, insider system that lenders and banks privately use to their advantage, a system they hope you never figure out. By the end of this presentation, you will have a rock-solid, actionable strategy to force lenders to compete for your business, guaranteeing you walk away with the absolute lowest interest rate possible for your specific situation. We are going to turn you from a price taker into a price maker. The biggest lie in the mortgage industry is that your interest rate is a reflection of you. It's not. It's a reflection of the lender's risk and their profit margin. You're walking into the most important negotiation of your life, and the other side has a team of underwriters, decades of data, and complex algorithms all designed to maximize their profit from you. What do most people have? A calculator app and a sense of overwhelming anxiety. We are going to level the playing field right now. We're going to arm you with the same understanding they have so you can navigate the system with confidence and come out on top. So how do we do it? First, we have to pull back the curtain and understand how lenders actually decide your rate. It's not some magic number pulled from a hat. It's a calculation based on a handful of key factors, some of which you've heard of, and some of which are intentionally kept behind the scenes. Let's break them down because understanding these is the first step to controlling them. The most obvious one, of course, is your credit score. But here's the first secret. Your exact score doesn't matter as much as you think. Lenders don't care if your score is a 765 or a 775. They care about tiers. Think of it like a video game. Hitting a certain level unlocks new abilities. For mortgages, the key FICO score tiers are generally around 680, 700, 720, and 760. Crossing from a 719 to a 720 can have a dramatic impact on your rate, while going from a 725 to a 740 might do almost nothing. The lender's pricing engine just checks which box you fit in. So your goal isn't to get a perfect 850 score. Your goal is to identify the next tier up from where you are now and do everything in your power to cross that threshold before you apply. That simple act of moving up one tier can be the difference of a quarter point on your rate, which, as we've seen, translates into tens of thousands of dollars. Next, and arguably more important than your credit score, is the number most people ignore: your DTI, or debt-to-income ratio. In simple terms, this is how much of your monthly gross income goes toward paying your debts. Lenders are obsessed with this number. It is their single greatest indicator of your ability to repay the loan. It's not about how much you make. It's about how much you keep. You could make $200,000 a year, but if you have huge student loans, 2 big car payments, and high credit card bills, your DTI might be dangerously high. A lender might see you as riskier than someone who makes just $80,000 a year, but is completely debt-free. Here's the strategy. Lenders typically want to see a back-end DTI. That's all your monthly debts plus your new proposed mortgage payment, of no more than 43%. The lower, the better. Getting your DTI under 36% makes you a prime borrower, the kind of client they fight over. So before you even think about talking to a bank, calculate this number. Add up all your monthly debt payments, car, student loan, credit cards, everything, and divide it by your gross monthly income. If that number is high, you have a new mission. Can you pay off that last $5,000 on your car loan before you apply? Doing so could remove a $400 monthly payment from your DTI calculation, drastically lowering your ratio and making you look like a much stronger borrower, instantly qualifying you for a better rate. The third critical factor is LTV, or loan-to-value. This is just a fancy way of saying, how much skin do you have in the game? It's the percentage of the home's price that you're borrowing. If you buy a $500,000 house with $100,000 down, you're borrowing $400,000. Your LTV is 80%. Now, everyone knows that putting 20% down helps you avoid PMI, or private mortgage insurance, which is a massive win. But the secret is that the benefits don't stop there. Just like with credit scores, LTV operates in tiers. An LTV of 80% is good, but an LTV of 75%, meaning you put 25% down instead of 20%, is even better. To a lender, that extra 5% signals a huge reduction in their risk. It shows you're more financially stable and less likely to default. As a reward, they will often offer you a significantly lower interest rate. It's always worth asking your loan officer, what is the rate difference between 20% down and 25% down? The answer might shock you, and the long-term savings could far outweigh the initial extra cash. Now for a factor most buyers never even consider: the property itself. Yes, the type of home you buy can directly affect your interest rate. Why? Because a lender is assessing the risk of the collateral, the house. A standard single-family home in a good neighborhood is the safest bet for them. It's easy to value and easy to sell if things go wrong. But what if you're buying a condo? Well, now the lender has to worry about the financial health of the entire condo association. What if you're buying a multi-unit duplex or a triplex? That's a different kind of loan with different risk calculations. A manufactured home? Different again. The further you stray from the standard single-family home, the more perceived risk there is for the lender, and that risk is often passed on to you in the form of a slightly higher interest rate. This doesn't mean you shouldn't buy these properties, but you need to go into it with your eyes open, knowing that the rate you're quoted might be higher because of the property type itself. Finally, we arrive at the biggest secret of all, the one that gives us, the borrowers, all the power. After a lender takes your credit score tier, your DTI, your LTV, and the property type, they have a base rate. But that's not the rate they offer you. On top of that base rate, every single bank, every credit union, every mortgage company adds two final things: their internal risk rules called overlays, and their own unique profit margin. And this margin is where the game is won or lost. It's the wiggle room. It's the negotiation space. The difference between Bank A's final offer and Bank B's final offer for the exact same person buying the exact same house has almost nothing to do with you. It has everything to do with their business goals that specific week. Is Bank A behind on its lending quota for the month? They might shrink their profit margin to win more deals. Did Bank B just spend a fortune on a Super Bowl ad and need to make up the cost? Their margin might be higher. This is the weakness in their armor. The fact that their pricing is not standardized across the industry is the opportunity we are going to ruthlessly exploit with the strategies we'll cover next. You are not just applying for a loan, you are creating a bidding war. And you are the prize. To win this war, you first need to understand the battlefield. Why would one bank offer you a loan at 5% while another just down the street offers the exact same loan at 4.5%? Seems insane. It's because each lender is a unique business with its own unique math. Bank A might have a higher overhead, more expensive offices, and bigger marketing budgets they need to cover. Bank B might be aggressively trying to grow its market share this quarter, so they're willing to make less profit on each loan just to get more customers in the door. Lender C might specialize in loans for people with your exact financial profile, so their risk model sees you as a safer bet than a generalist bank would. And Lender D might have just received a massive infusion of cash they need to lend out fast, making them hungry for deals. They aren't a monolith. They are individual, competing businesses. And your loan application is the product they are all bidding to acquire. Our job is to make that product you so irresistible, so perfectly polished that their bids get lower and lower and lower. This isn't about luck. It's about preparation. Before you ever speak to a single loan officer, you need to forge yourself into the perfect borrower. We do this by focusing on the 3 pillars of mortgage qualification: your credit score, your debt-to-income ratio, and your down payment. Get these 3 right and lenders will be fighting over you. Get them wrong and you'll be begging for scraps. Let's start with the big one: your credit score. This is your financial report card, and in the world of mortgages, not all scores are created equal. Lenders almost exclusively use a specific version of the FICO score, not the Credit Karma Vantage score you might be used to seeing. So, your first piece of homework is to get your actual FICO scores. You can often get them for free from your credit card company's website, or by paying for a service like myfico.com. Now, what's the magic number? While you can get a loan with a score in the 600s, you won't get a good rate. The game truly begins at a 740 FICO score. This is the tier where lenders see you as a low-risk, responsible borrower. Crossing this threshold is like getting a VIP pass at the club. Suddenly, doors open, and the best pricing becomes available. If you can push that score to 760 or even 780, you're in the Platinum Lounge. The difference between a 680 score and a 760 score on a $400,000 loan can literally be over $100,000 in extra interest payments over the life of the loan. $100,000 for the exact same house. That is the power of this number. So, how do you boost it quickly? Your score is made up of 5 factors, but 2 of them are king: your payment history, which is 35% of your score, and your credit utilization, which is 30%. Payment history is simple. Never ever be late. One 30-day late payment can tank your score by 50 to 100 points and stay on your record for 7 years. If you have any collections or late payments, deal with them now. Call the creditor, negotiate a pay for delete, where they agree to remove the negative mark in exchange for payment. Get it in writing. The second factor, credit utilization, is your secret weapon for a fast score boost. This is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $3,000 balance, your utilization is 30%. The golden rule is to keep your utilization below 30% on every single card, but the Real pros keep it below 10%. If you have high balances, paying them down is the fastest way to see a significant jump in your score, sometimes in as little as 30 days. Here's a pro tip: do not, under any circumstances, close old credit cards you don't use. A huge part of your score is your average age of accounts. Closing an old card shortens your credit history and reduces your total available credit, which can actually hurt your score. Just cut up the card if you don't trust yourself, but leave the account open. The second pillar is your debt-to-income ratio, or DTI. This is Wall Street's way of asking a very simple question: can you actually afford this? DTI is the percentage of your gross monthly income. That's your income before taxes. That goes toward paying your monthly debt obligations. This includes your potential new mortgage payment, property taxes, homeowner's insurance, plus car payments, student loans, and credit card minimum payments. There are 2 numbers lenders look at: the front-end ratio, which is just your potential housing payment against your income, and the back-end ratio, which is all your debts combined. The back-end is the one they are obsessed with. For most conventional loans, lenders want to see a DTI of 43% or lower. Some programs might stretch to 45 or even 50%, but the lower your DTI, the safer you look. A low DTI tells the lender you have breathing room. If you lose your job or have a medical emergency, you're less likely to default on your mortgage. You are a safer bet. To prepare for the bidding war, calculate your DTI right now. Add up all your monthly debt payments, add an estimated mortgage payment, and divide it by your gross monthly income. If that number is high, say over 45%, you have work to do. The most powerful move is to eliminate small debts entirely. Do you have a personal loan or a car payment with only a year or 2 left? If you have the cash, paying it off completely before you apply for a mortgage can have a massive impact. Wiping out a $400 monthly car payment is the equivalent of a lender thinking you can afford almost $75,000 more on your home loan. It drastically increases your buying power and makes you a much stronger applicant. Finally, we have the third pillar, your down payment and assets. The old rule was that you need 20% down. This is one of the biggest and most persistent myths in real estate. You do not need 20% down. There are conventional loans that allow as little as 3% down and FHA loans that start at 3.5%. However, putting down less than 20% comes with a cost: private mortgage insurance, or PMI. PMI is an insurance policy that protects the lender, not you in case you default. It can add a few $100s to your monthly payment. So, while you don't need 20%, the more you can put down, the better. A larger down payment reduces the lender's risk, which can lead to a better interest rate. It also shows you have financial discipline and savings. Lenders will want to see where this money came from. They need to see that it has been seasoned, meaning it's been sitting in your bank account for at least 2 to 3 months. A sudden massive deposit of $50,000 a week before you apply for a loan is a giant red flag. They'll think it's an undocumented loan from a relative, which counts as a debt and messes up your DTI. So if you're getting a gift from family, get the money into your account early and be prepared with a signed gift letter stating it's a true gift, not a loan. These 3 pillars, a high FICO score, a low DTI, and a well-documented down payment, are the foundation of our strategy. They are your armor and your sword for the war ahead. Taking the time, even if it's 3 to 6 months, to perfect these elements before you apply will save you tens, if not hundreds of thousands of dollars. It transforms you from a risky applicant into a premium, grade A borrower, the kind lenders drool over. Now that we know how to polish the prize, it's time to choose the arena for our bidding war. Where do you actually go to get these lenders to compete? This is the step where most people make their first and most expensive mistake. They walk into their local big bank and just accept whatever they're offered. This is like going to a single car dealership and buying the first car the salesman shows you without checking any other prices. It's financial malpractice. The type of lender you choose to work with, a big bank, a local credit union, a direct online lender, or a mortgage broker, will have a bigger impact on your interest rate than almost any other factor. Each one has hidden strengths and critical weaknesses. And in the next part, we're going to break them all down, and I'll reveal the one that gives you, the buyer, the most leverage to force them to compete and drive your rate into the ground. Alright, let's pull back the curtain on this hidden world. To truly understand how to get the lowest rate, you first need to understand the players on the field. Think of it like a marketplace with 4 different types of sellers, each with their own playbook. First up, we have the Goliaths, the big retail banks. These are the household names you see plastered on skyscrapers and sponsoring Super Bowl halftime shows. Chase, Bank of America, Wells Fargo. You probably have a checking or savings account with one of them right now. And that's their biggest advantage: convenience. You already have a relationship, an app on your phone, and a branch on the corner. They'll dangle loyalty discounts and relationship pricing in front of you, making it seem like the easiest, most logical choice. It's the path of least resistance. But here's the catch. That convenience comes at a staggering, often hidden cost. These banks are massive bureaucratic machines with immense overhead. They have thousands of branches, tens of thousands of employees, and massive marketing budgets. And guess who pays for all that? You do. It's baked right into your interest rate and fees. They have a limited menu of loan products, only their own. They can't shop around for you. Going to them for a mortgage is like going to a Ford dealership and asking them to find you the best price on a Toyota. It's just not going to happen. Their loan officers are employees of the bank, and their primary loyalty is to the bank, not to you. While they might offer a decent rate now and then, especially to a high net worth client, they rarely have the absolute lowest rate on the market because their business model simply can't support it. They're betting that you'll pay a premium for familiarity. Next, we have the community champions, the credit unions. These guys are the polar opposite of the big banks. They're nonprofits, owned by their members. That's a huge deal. Because they don't have shareholders to please, they can pass their profits back to their members in the form of lower rates and fewer fees. On paper, this sounds like a guaranteed win. And sometimes it is. You'll often find that a credit union's advertised rates are extremely competitive. They offer a more personal, hands-on approach. You're a member, not just an account number. But the community champion has weaknesses too. First, you have to be eligible to join. They often have membership restrictions based on where you live, where you work, or your affiliation with a certain group. Second, they can be slow. Their technology often lags behind the big players, leading to a clunkier, more paper-intensive process. Their underwriting can also be more rigid and conservative. If your financial situation is anything but a straightforward W-2 job with a 20% down payment, you might find yourself hitting a brick wall. They have a limited selection of loan programs and often aren't equipped to handle complex scenarios like self-employment income or unique property types. So while they can be a fantastic option for the right person, they're not a one-size-fits-all solution, and their attractive advertised rate might not be the rate you actually get once you're deep into the process. Now let's move on to the third player, the specialist. This is the direct mortgage lender, also known as a mortgage banker. You might know them by names like Rocket Mortgage or Loan Depot. Their entire world is mortgages. That's all they do day in and day out. And that specialization is a powerful advantage. Because they are hyper-focused, their process is often incredibly streamlined, efficient, and fast. They control everything in-house, from the application to the underwriting to the funding of the loan. This gives them a ton of control over the timeline, which can be a lifesaver in a competitive housing market where you need to close quickly. Their loan officers are often very knowledgeable because they live and breathe this stuff. But here's the critical piece of information you need to understand. Just like the big banks, a direct mortgage lender can only offer you their own products and their own rates. They are a single source. They have their own pot of money and their own set of rules. They might have a wider variety of mortgage-specific products than a big bank, but you are still stuck in their ecosystem. They are not shopping the market for you. They are selling you their product. Their loan officer's job is to convince you that their company's rate is the best you can get. They might be a specialist, a surgeon with a scalpel, but they're still working for the hospital, not for you, the patient. They can be very competitive, and they spend billions on advertising to convince you they have the lowest rates. But they are fundamentally incapable of creating true, market-wide competition for your loan. And that brings us to the fourth player. The one I've been building up to. The one that fundamentally changes the game and shifts the power from the lender to you. This is the independent mortgage broker. A mortgage broker is not a lender. This is the single most important distinction to grasp. They don't have a giant pot of money they're trying to lend you. They aren't selling you their own company's product. A mortgage broker is a licensed professional whose entire job is to be your personal shopper for a home loan. Think of it this way: the big bank is the Ford dealership. The direct lender is the Tesla showroom. The credit union is the local co-op. The mortgage broker, on the other hand, is like a personal car buying expert who has access to the inventory and wholesale pricing of every single dealership in the state: Ford, Toyota, Tesla, Honda, you name it. They take your single application and submit it to dozens of different wholesale lenders simultaneously. These lenders are names you've probably never heard of, because they don't have retail branches or spend money on Super Bowl ads. They are lean, mean rate-slashing machines that compete exclusively on price and service to win the broker's business. This process creates a bidding war for your loan. Lender A sees what Lender B is offering and comes back with the lower rate. Lender C sees that and drops their fees to beat them. The broker orchestrates this entire competition on your behalf. Their loyalty is, by law and by business model, to you. They work for you, not the bank. They have access to a vast array of loan products from all these different lenders, so if you have a unique situation, you're a gig worker, you have a lower credit score, you're buying a weird property, they can find a niche lender who specializes in exactly that. They do all the legwork, all the shopping, and all the negotiating. They sift through all the fine print and present you with the best options. They know the market inside and out and can advise you on when to lock your rate and which lender has the fastest turn times. Now, are all brokers created equal? Absolutely not. A bad broker can be just as frustrating as any other option. But a great broker is, without question, the single most powerful weapon a homebuyer has to secure the absolute lowest interest rate possible. They are the only player in this game whose success is directly tied to your success in getting the best deal. They introduce pure, unadulterated competition into a process that the big banks and direct lenders would rather keep opaque. They turn the tables, making the lenders fight over you, instead of you begging for their approval. This is the leverage you've been looking for. So we've identified the most powerful player on the field. The one that gives you, the buyer, the ultimate advantage. But knowing you need a broker is only half the battle. The market is flooded with them, and picking the right one is the difference between saving tens of thousands of dollars and getting stuck in a nightmare of missed deadlines and broken promises. So how do you spot the good ones and run from the bad? First, you have to understand the two types of bad brokers you're most likely to encounter. There's the incompetent broker, who means well but is disorganized, inexperienced, and ultimately costs you money through sheer sloppiness. And then there's the malicious broker, who knows exactly what they're doing, steering you toward high-commission loans that benefit them, not you. Both can derail your dream home, but one is a pothole, the other is a calculated trap. Your job is to avoid both. The first step is building a list of candidates. Where do you find them? The most common answer is a referral from your real estate agent. And this can be a great source, but you have to approach it with a healthy dose of skepticism. Think about it. Good agents want deals to close smoothly, so they'll recommend brokers who are competent and reliable. That's a plus. But there's also a potential conflict of interest. Some agents and brokers have cozy relationships. They send business back and forth, they go on golf trips together. This doesn't automatically mean they're bad, but it can mean the agent is recommending their friend, not necessarily the absolute best person for your specific financial situation. The rule here is simple. Take your agent's recommendation, put that broker on your list, but never, ever let them be the only one on your list. Your next source is your personal network. Ask friends, family, or coworkers who have bought a home in the last couple of years. This is often the most reliable source for honest feedback. Ask them specifically, did your broker communicate well? Were there any last-minute surprises? And would you use them again? That last question is the most important one. Someone might have gotten the deal done, but if the process was a nightmare, they'll hesitate when you ask if they'd go through it again. Finally, there's the internet. You can use sites like Zillow or Bankrate to find local brokers, but be careful. Online reviews can be manipulated. A flashy website doesn't mean they're good at closing loans. Use online searches to expand your list, but treat these candidates with the highest level of scrutiny. Now you have a list. Maybe it has 3 names, maybe it has 10. Your next step is non-negotiable, and it's what I call the rule of 3. You must interview in depth at least 3 different brokers. Not 1, not 2, 3. Why? Because interviewing only one gives you no perspective. You have no idea if their fees are high or their rates are competitive. Interviewing 2 just gives you a simple choice between A and B. But when you interview 3, a powerful pattern emerges. You'll start to see what a standard fee looks like. You'll hear what a competitive rate sounds like. One broker will stand out as more knowledgeable, another as a better communicator. The third interview is what gives you the context to make an intelligent decision, instead of just a guess. It turns you from a passive customer into an informed shopper. So you've scheduled the calls. What do you ask? This is where you separate the pros from the amateurs. Don't just ask, what's your best rate? That's a rookie question. The rate they quote you on a 10-minute phone call is meaningless. It's a marketing number. You need to dig deeper. Here are the 5 killer questions you must ask every single broker. Question 1. How many lenders are in your network, and can you name a few you think might be a good fit for me? A broker's power comes from their options. A broker with access to 50 lenders is an arsenal. A broker with access to 5 is a pocket knife. You want the arsenal. If they can't name at least 20 or 30 lenders off the top of their head, that's a concern. The second part of the question is a test. By asking who might be a good fit, you're seeing if they're actually listening to your situation or just giving a generic sales pitch. A great broker will say something like, based on your down payment, we might look at Rocket Mortgage for their speed, but if your credit is borderline, maybe a lender like United Wholesale Mortgage would be better, because their guidelines are more flexible. They're already strategizing. That's the sign of a pro. Question 2. How are you compensated? This is the big one. Brokers get paid in one of 2 ways: lender-paid compensation or borrower-paid compensation. With lender-paid, the lender gives the broker a commission, typically a percentage of the loan amount. This costs you nothing out of pocket. With borrower-paid, you pay the broker a fee directly. On the surface, lender-paid sounds like a no-brainer. Free is good, right? But here's the secret. Nothing is free. When the lender pays the broker, they often build that commission cost into your interest rate, making it slightly higher. A broker who is only lender-paid might be tempted to push you toward the lender that pays them the highest commission, not the one that gives you the best deal. A transparent broker will explain both options clearly. They'll be able to say, I can get you a rate of 6.5% with no fee, or you can pay me a 1% fee and I can get your rate down to 6.25%. They'll then run the numbers and show you which option saves you more money over the long term. A shady broker will get defensive. If they're cagey about how they get paid, that is a massive red flag. Run. Question 3. What are all the fees I can expect from the lender and from you? Can you provide me with a detailed loan estimate? This question cuts through all the noise. The loan estimate, or LE, is a standardized, government-mandated document that breaks down every single cost associated with the loan. It includes the interest rate, the monthly payment, and all the closing costs, from origination fees to title insurance. A broker who says, "Oh, we'll get to that later," is hiding something. A great broker will say, "Absolutely. As soon as I have your basic information, I can generate a preliminary estimate for you, so you can see the real numbers." Comparing the official loan estimates from your top 3 candidates is the single most effective way to compare offers apples to apples. Question 4. What is your communication style? And who will be my primary point of contact? The mortgage process is stressful. There will be times you have an urgent question at 7 p.m. on a Tuesday. Will you be able to reach your broker? Or will you just get their voicemail? Some brokers work on a team. You might speak to the main broker for the strategy, but then work with a loan processor for the paperwork. That's perfectly fine, as long as it's explained up front. You need to know who to call and what to expect. If they promise you 24/7 access, be skeptical. If they promise a call back within a few business hours, that's realistic and professional. This question is about setting expectations and avoiding the frustration of feeling like you're screaming into the void when you need an answer most. And the final killer question, number 5. Looking at my financial profile, what potential roadblocks or challenges do you foresee? This question separates the salespeople from the true advisors. A salesperson will tell you everything is perfect. Don't worry, your application is a slam dunk. An advisor, a true expert, will be honest. They'll say, your debt-to-income ratio is a little high, so we'll need to be strategic about which lender we approach first. Also, that recent job change might require some extra documentation. This isn't negative, it's realistic. It shows they have the experience to anticipate problems before they happen. You want a broker who is a pessimist in the planning stage so they can be an optimist at the closing table. By asking these 5 questions, you'll have a crystal clear picture of who you're dealing with. One broker will offer a slightly lower rate, but have terrible answers on communication. Another will be a great communicator but have a tiny network of lenders. And one, hopefully, will check all the boxes: experienced, transparent, strategic, and a good communicator. That's your broker. But even with the right questions, you have to be on the lookout for the telltale signs of a bad actor. If a broker ever guarantees you a specific interest rate on the first phone call, before they've seen a single document, hang up. That's not a broker. It's a bait-and-switch artist. If they pressure you saying a rate is a one-day-only special, and you have to lock it in right now, walk away. That's a high-pressure sales tactic, not a financial strategy. And if they're impossible to get a hold of during the interview process, imagine how bad it will be once they have your business. Choosing a broker is your first major decision in the home buying journey, and it sets the tone for everything that follows. It's not just about finding the person who quotes the lowest number. It's about finding a partner who will guide you through one of the most complex transactions of your life. Take the time to do it right. Interview 3 candidates. Ask the hard questions. Trust your gut, because once you've secured that expert in your corner, they're going to turn to you and ask for the single most important document in this entire process. It's the key that unlocks every lender's door, and it dictates the terms you'll be offered. It's not your tax returns, it's not your bank statements, it's your credit report. And the 3-digit number at the top of that report holds more power over your financial future than you can possibly imagine. Before you let any lender see it, you need to understand exactly what it says, how to fix its flaws, and how to position it to get you the absolute best deal possible. And that is exactly what we're going to break down next. Think of your credit report not as a report card, but as your financial resume. It's the single most important document a lender will look at to decide not just if they'll lend you hundreds of thousands of dollars, but at what price. A single, overlooked error on this document could cost you tens of thousands of dollars over the life of your loan. This isn't an exaggeration. It's the cold, hard reality of the mortgage industry. So let's pull back the curtain. First, you don't have one credit report. You have 3. One from each of the major credit bureaus: Experian, Equifax, and TransUnion. Think of them as 3 different biographers, all writing the story of your financial life. They get their information from banks, credit card companies, and other lenders you do business with. But here's the critical part. They don't always talk to each other. A credit card company might only report to Experian and TransUnion. Your car loan might only report to Equifax. This means each report can be slightly different. They might have different accounts listed, different balances, and most importantly, different errors. A lender will typically pull all 3 reports and use the middle of your 3 credit scores for their decision. That's why you can't just look at one. You have to scrutinize all 3. When you open up one of these reports, it can look like an intimidating wall of text and numbers. But it really boils down to 4 key sections. First is your personal information. This seems basic, but errors here are a massive red flag for identity theft. Check your name, address, social security number, and date of birth. Is there an old address you don't recognize? Is your name misspelled? These small mistakes can create huge delays and complications during the underwriting process. Second, and this is the core of the report, is your credit accounts, also known as trade lines. This is a list of every loan and line of credit you have or have had in the past 7 to 10 years. You'll see two main types. Installment accounts like a mortgage, student loan, or auto loan. These are loans with a fixed number of payments over a set period. Think of it like a staircase you walk down one payment step at a time until you reach the bottom. Then you have revolving accounts, which are your credit cards and lines of credit. These are like a bucket of water. You can use some, pay it back, use it again. The lender wants to see how you manage both types of credit. They'll look at your credit limit, your current balance, and your payment status for every single account. This leads us to the third and arguably most important section: your payment history. This is the GPA of your financial life. It's a month-by-month grid for each account, showing whether you paid on time. You'll see little check marks or OK for on-time payments. But what you're really looking for are the codes for late payments. 30 days late, 60 days late, 90 days late. A single 30-day late payment from 2 years ago can drop your credit score by 60 to 100 points. A 90-day late payment is a financial nuclear bomb. It can stay on your report for 7 years and is one of the biggest roadblocks to getting a low interest rate. Lenders see a late payment as a breach of promise. If you were late paying a $200 credit card bill, what's their guarantee you'll be on time with a $2,000 mortgage payment? The fourth section is credit inquiries. This is where a lot of fear and misinformation lives. There are two types: soft inquiries and hard inquiries. A soft inquiry is when you check your own credit, or when a company pre-screens you for a credit card offer. These have zero impact on your score. A hard inquiry is when a lender checks your credit because you have applied for new credit. This is the one that can temporarily ding your score by a few points. But here is the secret the credit bureaus don't advertise loudly. The scoring models are smart. They know when you're rate shopping for a major loan. If you apply for 5 different mortgages within a 14 to 45-day window, depending on the scoring model, it will be treated as a single hard inquiry. The system recognizes you're looking for one loan, not 5. So don't be afraid to shop around. Fear of multiple inquiries is a myth that costs homebuyers thousands by preventing them from comparing offers. Now, a crucial distinction. Your credit report is not your credit score. The report is the detailed story of your financial habits. The score is just the 3-digit headline. And believe me, lenders read the entire story. A 750 score is great, but if the report shows that you got that 750 by maxing out all your credit cards last month, a lender will be far more hesitant than if they see a 730 score with a long history of responsible, on-time payments and low balances. The details in the report provide the context, and context is everything. So, how do you get this all-important document? Do not go to the first site that pops up on a search engine. Many are just trying to sell you a monthly subscription. The only official, federally authorized source for your free reports is annualcreditreport.com. That's it. You are legally entitled to a free copy of your report from each of the 3 bureaus once every week. Once you have all 3 reports in front of you, it's time to perform your own pre-lender audit. This is what you do before any mortgage lender sees your file. Grab 3 different colored highlighters. Go through each report line by line. First, highlight any personal information that is incorrect. Any address you've never lived at. Any misspelling of your name. Second, look at the accounts. Do you recognize every single one? If there's a credit card from a store you've never shopped at, that's a major red flag for fraud. Is there an old account from a decade ago that should have fallen off but hasn't? Is there a loan that you co-signed for a family member that you forgot about? It's on your report, and it's affecting your debt-to-income ratio. Third, and most critically, scrutinize the payment history of every account. Did they mark you as 30 days late in a month you know you paid on time? Clerical errors happen all the time. Maybe you had an account with an ex-spouse that they were responsible for, but they made a late payment and it's now staining your record. You need to find these mistakes. Any account that has been sent to collections needs a deep dive. Is the balance correct? Is it even your debt? Finding these errors is the first step. The second is disputing them. The Fair Credit Reporting Act gives you the legal right to challenge any information on your credit report that you believe is inaccurate, and the credit bureaus are legally obligated to investigate. This isn't a quick process. It can take 30 to 45 days for an investigation to conclude, and sometimes requires follow-up. This is why you must do this audit months, ideally 6 months, before you plan to even talk to a lender. You are cleaning up your financial resume before the biggest job interview of your life. Fixing errors is playing defense. It's about removing the negative items that are unfairly dragging you down. But once your reports are clean and accurate, that's when the real game begins. That's when you shift from defense to offense. It's time to start strategically and actively building your credit score, pushing it into the highest tiers where the absolute lowest interest rates live. And there are specific, powerful techniques, some of which are completely counterintuitive, that can add 50, 75, even 100 points to your score in a matter of months. We're going to cover the exact blueprint for doing just that in the very next part. First, let's get one thing straight. The generic advice you hear everywhere, pay your bills on time, and don't take on too much debt, is fine. It's like telling someone who wants to be a world-class athlete to eat healthy and get some exercise. It's not wrong, but it's not the secret blueprint that creates champions. Paying your bills on time is the bare minimum. It's the price of admission. It will slowly, over many years, build a decent score. But we're not talking about a slow 10-year plan. We're talking about a rapid targeted strike to add a massive number of points to your score in the next 60 to 90 days, right before you apply for that mortgage. The single most powerful lever you can pull to quickly boost your credit score is something called your credit utilization ratio. This factor alone accounts for a whopping 30% of your FICO score. That's the same weight as your entire payment history. Think about that. One single metric is as important as years and years of on-time payments. And unlike your payment history, you can change your utilization ratio dramatically in under 30 days. So what is it? It's simply the amount of revolving credit you're using compared to the total amount of revolving credit you have available. Let's say you have one credit card with a $10,000 limit. You currently have a balance of $3,000 on it. Your utilization is 30%. Simple. The standard advice is to keep this ratio below 30%. Again, that's not bad advice. But it's not elite advice. The people with 800+ credit scores, the ones who get the absolute best interest rates, live by a different rule. They keep their utilization below 10%. And for a supercharged maximum point boost, the secret number is 1%. Getting your reported balance as close to zero as possible, without it actually being zero, is the holy grail. But here's the counterintuitive trap that snares millions of responsible people. You might be paying your credit card bill in full, every single month on time, and your credit score is still being suffocated by high utilization. How is this possible? Because of a dirty little secret in the credit industry. Most credit card companies only report your balance to the credit bureaus once a month, and they don't report it on the day you pay your bill. They report the balance that's on your monthly statement. Let me give you an example. Let's say your credit card statement closes on the 15th of every month, and your payment is due on the 10th of the next month. You use your card for everything, gas, groceries, bills, and you rack up a $4,000 balance on your $5,000 limit card. On the 15th, your statement is generated showing that $4,000 balance. That's an 80% utilization ratio. Then, like a responsible person, you pay the full $4,000 before the due date on the 10th. You think you're at 0% utilization, right? Wrong. The credit card company has already reported that 80% utilization figure to Experian, Equifax, and TransUnion. As far as the credit bureaus are concerned, you are maxing out your card every month, which makes you look like a high-risk borrower. This one misunderstanding can cost you 50 points or more. So here's the fix. It's called the prepayment strategy. Find out your statement closing date for every single credit card you have. You can find it on your statement or by calling the number on the back of the card. Then, set a reminder on your phone for 3 to 5 days before that date. On that day, log in and pay your balance down to a tiny amount, say 1% of your limit. If you have a $10,000 limit, pay it down so only $100 is left. Let that be the balance that gets reported. Then, after the statement comes out, you can pay off that remaining small amount. By doing this, you are strategically controlling the exact data that gets sent to the credit bureaus. This single technique can cause a massive jump in your score in the very next reporting cycle. The second way to slash your utilization is even simpler. Get a credit limit increase. If you have a $2,000 balance on a $5,000 limit card, your utilization is 40%. If you call your credit card company and they increase your limit to $10,000, your utilization on that same $2,000 balance is now just 20%. You just cut it in half without paying a single penny. Most credit card companies have a link on their website or a prompt in their automated phone system to request an increase. When they ask for your income, make sure you include your entire household income. It's a 5-minute task that can add 15 to 20 points to your score. Now for the second pillar of our Rapid Score Boost blueprint. This one feels like cheating, but it's 100% legal and incredibly effective. It's called piggybacking, or becoming an authorized user. If you have a trusted family member, a parent, a spouse, even a sibling, who has a long history of responsible credit use, you can ask them to add you as an authorized user on one of their oldest, highest limit credit cards. Here's why it's so powerful. When they add you, the entire history of that account can be grafted onto your credit file. If your mom has a 20-year-old credit card with a $25,000 limit and a zero balance that she's never missed a payment on, that entire positive history can suddenly appear on your report. This instantly increases your average age of accounts, lowers your overall credit utilization, and adds a long history of on-time payments. It's like getting a credit history transplant. Now the obvious concern is, I don't want them to mess up my credit, or I don't want to mess up their credit. The solution is simple. You don't ever need to see, touch, or use the physical card. Just have them add your name to the account. When the card arrives at their house with your name on it, they can just cut it up. You're not doing this to borrow their money, you're doing it to borrow their data. This one move can be the difference maker that pushes you over the 740 or 760 score threshold. The third and final pillar is the error dispute blitz. According to the Federal Trade Commission, 1 in 5 Americans has a legitimate, verifiable error on their credit report. 1 in 20 has an error so serious it would cause them to be denied a loan or pay a significantly higher interest rate. You could be doing everything else right, but a single mistake made by a lender 10 years ago could be silently sabotaging your score. Your mission is to become a credit detective for one afternoon. Go to annualcreditreport.com. That is the only official, truly free site run by the government. Do not go to any other site that promises free scores. They are just trying to sell you something. You are entitled to a free report from all 3 bureaus, Experian, Equifax, and TransUnion, every single week. Pull all 3. They will not be identical. Scan every single line item. Are there late payments listed for accounts you know you paid on time? Are there accounts on there you don't even recognize? Is a collection account still showing up that's more than 7 years old? Is your name or address spelled incorrectly? Any of these can be disputed, and by law, the credit bureaus have 30 days to investigate. If the creditor who reported the information can't prove it's accurate, the bureau must remove it. Getting a single erroneous late payment or a bogus collection account removed can boost your score by 30, 40, or even 50 points overnight. So let's put this into a 60-day action plan. Month 1. Pull your credit reports and dispute every single error you find. At the same time, call all your credit card companies and ask for a credit limit increase. Then, identify a family member and have that authorized user conversation. Month 2. Implement the prepayment strategy. Find your statement closing dates and start paying your balances down to 1% a few days beforehand. While you're doing all this, there are 2 things you absolutely must not do. First, do not close any old credit card accounts, even if you don't use them. Closing an old account shortens the average age of your credit history, and more importantly, it removes that available credit from your total, which will instantly increase your utilization ratio and lower your score. Just cut up the card if you don't want to use it, but keep the account open. Second, do not, under any circumstances, go out and apply for new credit right before you apply for a mortgage. No new car loans, no new store credit cards, nothing. Every application triggers a hard inquiry, which can temporarily ding your score, and more importantly, it raises a huge red flag for mortgage underwriters. They want to see stability, not a sudden rush for more debt. Following this blueprint, slashing utilization, piggybacking on good history, and cleaning up errors is the fastest, most effective way to optimize your credit profile. It's how you take control of the numbers instead of letting them control you. This isn't about hoping your score goes up. It's about forcing it to go up. And once your score is dialed in, you're ready to face the lenders. But walking into a bank unprepared is like walking into a final exam without ever going to class. You need a file of documents ready to go. This is what separates the amateurs from the pros. In the next part, we are going to build your shock and awe mortgage application package, the exact documents you need to gather, and how to present them in a way that makes lenders see you as a prime, low-risk borrower they're desperate to approve. Alright, let's build your weapon. Because that's what this is. It's not a pile of paperwork. It's a meticulously crafted tool designed to do one thing: eliminate any doubt in a lender's mind. When an underwriter, the person who holds the final stamp of approval, gets your file, you don't want them to sigh and start digging for information. You want them to sit up a little straighter. You want their first thought to be, wow, this person has their act together. That single impression can be the difference between a smooth approval and a week of stressful back and forth emails, or even a denial. This shock and awe package signals that you are a professional. You are serious, and you are the lowest risk applicant they will see all day. And low risk applicants get the lowest interest rates. So let's break down exactly what goes into this package. We're going to organize it around the 4 things every lender on planet Earth cares about: your income, your assets, your credit, and the property itself. We'll handle the property later, but for now we're building the file that proves you are a financial rock star. First, the pillar of power, your income. This is how you prove you can handle the monthly payments. What you need depends on how you earn a living. If you're a W-2 employee, this is straightforward. Lenders want to see stability. You're going to provide your W-2 forms for the last 2 years. Why 2 years? Because it shows a consistent work history. A single year could be a fluke, 2 years is a pattern. Next, you'll need your most recent pay stubs, usually covering a 30-day period. This proves your current income and shows your year-to-date earnings, confirming you're on track with what your W-2s show. If you get bonuses, commissions, or overtime, gather the documentation to prove a 2-year history of receiving that, too. The key is painting a picture of reliable, predictable income. Now, for my self-employed people, my entrepreneurs, my freelancers, this is where you shine, but you have to work a little harder to tell your story. A W-2 is a simple statement. Your documents need to be a compelling narrative. You will need your last 2 years of complete, filed federal tax returns, both personal and business. If you file a Schedule C, they want the whole thing. If you have an S-Corp or an LLC, they want the business returns like the 1120S or 1065. They are going to look at your net income, not your gross. This is critical. The money you write off to save on taxes reduces the income you can use to qualify for a loan. You can't have it both ways. In addition to 2 years of tax returns, you will need a year-to-date profit and loss statement, or a P&L. This shows the lender how your business is doing this year, right now. It bridges the gap from your last tax return to today. And you'll likely need a letter from your CPA confirming your business is active and in good standing. Think of it this way. You are building a case for the financial health and stability of your business. The more professional and organized your financial documents are, the more confident the lender will be in you. Okay, pillar number 2, your assets. This is the security pillar. It shows the lender you have the cash for the down payment and closing costs, and that you have reserves left over. Financial reserves are like a safety net. If you lose your job, the lender wants to know you can still make the mortgage payments for a few months. It makes them feel safe. For this, you'll need your most recent 2 months of statements for every single account where you have money. That means checking accounts, savings accounts, money market accounts, everything. And they will scrutinize these. Here is a massive pro tip. Lenders hate large, undocumented deposits. If you sold your car for $5,000 cash and deposited it, or if your parents gave you $20,000 for the down payment, you can't just have that money appear out of thin air. To an underwriter, a mysterious large deposit looks like an undisclosed loan from a friend or family member, which is a debt they didn't know about. And that's a huge red flag. So, for any non-payroll deposit that's significant, you need to source it. If it was a gift, you'll need a gift letter from the person who gave you the money, stating clearly that the money is a gift and not a loan that needs to be repaid. You'll also need proof of them giving you the funds and proof of you depositing it. If you sold something, you'll need a bill of sale and a copy of the check. Be proactive. Document everything. Don't make the underwriter come back and ask. You provide the answers before they even have the questions. Beyond your bank accounts, you'll also provide the most recent statements for any retirement or investment accounts, like your 401k, IRAs, or brokerage accounts. Even if you don't plan on using this money for the purchase, it demonstrates financial maturity and shows you have deeper reserves, which makes you an even stronger borrower. The third pillar is credit, which is really the pillar of trust. We've talked a lot about your credit score, but in the application you'll list out all your debts, car loans, student loans, credit card balances. The lender will pull your credit report to verify all of this. But what if you have a blemish on your record? A late payment from 2 years ago during a tough time? Don't hide from it. Get in front of it. This is where you use another powerful tool, the letter of explanation, or LOX. A LOX is a simple, brief, and honest letter explaining a negative item on your credit report. It's not an excuse, it's an explanation. For example, Regarding the 30-day late payment on my auto loan in May of 2022, my family experienced an unexpected medical emergency that disrupted our finances. We have since recovered, and as you can see, all payments for the subsequent 24 months have been made on time. That's it. Short, factual, takes responsibility and shows it's a past event, not a current habit. Preparing these letters in advance for anything questionable on your report shows the underwriter you're transparent and on top of your finances. So now you have all these documents. What do? You don't just stuff them in an envelope. You digitize them, scan every single page and save them as PDFs. And you name them with a clear, logical convention. Not scan_8392. Name them John _2024 PDF, John _2024 PDF, Create a folder on your computer and organize everything into subfolders. Income, assets, miscellaneous. When you send this to a loan officer, you send one single organized zip file or a link to a cloud folder. The loan officer opens it and doesn't see a chaotic mess they have to spend an hour sorting through. They see a perfectly organized file. Their job just got easier. Your application goes to the top of the pile. You look like the most competent, organized, and reliable borrower they've ever seen. This isn't just about providing documents. It's about psychology. It's about presentation. You are marketing yourself as the ideal investment. You've now done the hard work. You've built the perfect package. It's sitting there, a digital testament to your financial responsibility. You are ready. You have the ultimate leverage. But leverage is useless if you don't know how to apply it. Simply sending this package to one lender and accepting their first offer is like building a Ferrari just to drive it to the grocery store. You're leaving tens of thousands of dollars on the table. Now we need to take this perfect application package and use it to make lenders fight over you. We are about to run what I call the mortgage shopping gauntlet. A specific, timed strategy for getting multiple lenders to compete for your business in a way that forces them to drop their rates and fees to win you over. This is where the real savings happen. And in the next part, I'm going to walk you through that gauntlet step by step. Okay, you've done the hard work. You've polished your credit, saved your down payment, and you've gotten pre-approved. You have your first official loan estimate in your hands. Most people stop here. They see the numbers, they feel a little overwhelmed, and they just sign on the dotted line because it feels like the finish line. But this isn't the finish line. This is the starting gun. That first loan estimate isn't a final offer. It's an opening bid in an auction you are about to control. Welcome to the gauntlet. This is the single most important money-saving part of the entire home buying process, and almost nobody does it right. Here's the first thing you need to understand about the psychology of the lender. A loan officer's job is to close loans. They work on commission and they operate on volume. Their ideal customer is someone who takes the first offer, doesn't ask questions, and signs quickly. They are banking on the fact that you're too busy, too intimidated, or too uninformed to shop around. We are about to shatter that assumption. Your mission is to transform from their ideal, passive customer into their most challenging, most respected, and ultimately most profitable type of client, the one who knows their worth and makes them earn the business. So, you have loan estimate number 1. Let's call this lender A. Maybe it's from a big national bank, a local credit union, or the online lender you started with. It doesn't matter. What matters is that you have a complete, official 3-page document. Not a worksheet, not a fee summary, a real loan estimate. This is your leverage. Now you're going to contact lender B, lender C, and lender D. These are the other lenders you identified in the previous step. You are going to send a very specific, very powerful email. Do not do this over the phone. You want everything in writing. A paper trail is a power trail. Your email to lender B should sound something like this. Hello, loan officer name. I am currently in the process of securing financing for a home purchase, and I'm ready to move forward with the lender who can offer the most competitive terms. I have an official loan estimate from another lender for a 30-year fixed-rate loan. The offer is for a 6.75% interest rate with $2,500 in lender origination fees, which are the fees in Box A of the loan estimate. I've attached a redacted copy for your review. Can you please provide an official loan estimate that beats these terms? I'm looking to make a decision in the next 48 hours. Let's break down why this email is a masterpiece of negotiation. First, you sound professional and serious. You're not just kicking tires. Second, you state clearly that you have an official offer in hand. This tells them you're not bluffing. Third, you are hyper-specific. You state the rate and the exact lender fees. This prevents them from playing games where they lower the rate but secretly jack up the fees. You've already shown them you know where to look. Fourth, you create a sense of urgency. 48 hours. This tells them they can't put you on the back burner. They need to act now if they want a shot at your business. And finally, you attached a redacted copy. Why redacted? You black out the name of lender A. You don't want them to know who they're competing against. This prevents any backchannel conversations or assumptions about a competitor's pricing strategy. You are a neutral, powerful buyer, and they are competing against a faceless, aggressive offer. Now you wait. Lender B will come back with their own loan estimate. And here is where the magic begins. Let's say lender B comes back with a rate of 6.625% and lender fees of only $1,500. Fantastic! You've just saved yourself $1,000 in closing costs and lowered your interest rate for the next 30 years. But we are not done. We are just getting started. You now take lender B's superior offer, and you go back to your first choice, lender A, and you send another email. Hello, lender A's loan officer. Thank you for your initial offer. I'm following up because I've just received a competing official loan estimate that is substantially better. They are offering a rate of 6.625% with only $1,500 in lender fees. As I mentioned, I really enjoyed our initial conversation and would prefer to work with your team. Can you match or beat this new offer? I've attached their redacted loan estimate for your reference. Look at what you just did. You were polite but firm. You complimented them, which makes them want to keep you as a customer. But you also drew a very clear line in the sand. You presented them with concrete evidence that they are being beaten. You've turned the tables. The loan officer at lender A now has a choice. They can lose your business entirely, getting zero commission, or they can go to their manager, show them the competing offer, and ask for a pricing exception to keep you. 9 times out of 10, if they have room to move, they will. They've already invested time in you. It's cheaper for them to cut their profit margin than to lose the sale altogether. Let's say lender A comes back and says, okay, we can match the $1,500 in fees, and we can get the rate down to 6.5%. Incredible! You are now the proud owner of an offer that is significantly better than either of the first two. But we're still not done. Now you take lender A's new and improved offer, and you go to lender C. You send the exact same style of email. Hello, lender C's loan officer. I am deep in the lender selection process and have a leading offer on the table for a 6.5% rate with $1,500 in fees. Can you beat this? You are creating a bidding war. A reverse auction where the price goes down, not up. And you are the auctioneer. You repeat this process. You take the best offer and you present it to the next lender in line. Each round, you are shaving off basis points on the rate and hundreds of dollars in fees. Each email you send could be worth thousands, even tens of thousands of dollars over the life of your loan. Think about that. A 5-minute email could be worth more than a week's salary. Now at some point a lender will say, I'm sorry, that's the best I can do. I can't match that. This is not a failure. This is a victory. This is crucial information. It means you have successfully found that lender's absolute rock bottom price. You thank them for their time and you move on. You are not being rude. You are being a savvy financial operator. You continue this process with your 3 to 5 lenders until the counteroffers stop. You'll find that after 2 or 3 rounds, the improvements get smaller and smaller. Maybe one lender can't beat the rate, but offers a small lender credit to cover appraisal fees. You're now comparing offers that are razor thin in their differences. This is the sign that you have reached the bottom of the market. You have squeezed every last drop of savings out of the system. You have successfully navigated the gauntlet. Only now, after you have multiple lenders telling you they can't go any lower, do you make your final decision. You look at the final loan estimates side by side. You choose the one with the absolute best combination of interest rate, lender fees in box A, and any lender credits in box J. And then and only then do you call that winning loan officer and say the magic words. I'm ready to lock it in. The feeling you will have in that moment is pure financial empowerment. While everyone else is passively accepting the first offer they get, you orchestrated a competition that forced the multi-billion-dollar lending industry to bend to your will. You didn't just find the lowest rate, you created it. You earned it. And the savings you locked in will pay dividends every single month for decades to come. This process might seem intimidating. It might feel confrontational. But remember, this is business. It's not personal. You are a highly qualified borrower. A valuable customer that any bank would be lucky to have. You are simply doing your due diligence to ensure you get a fair market price. And the reality is, loan officers respect customers who do this. It shows you're serious and you know what you're doing. So, the next step is to choose your champion, the lender you're going to lock in your incredible new rate with. But locking the rate isn't the end of the story. There are still pitfalls and traps that can cost you money between the rate lock and the closing table. And I'm going to show you exactly how to protect the amazing deal you just fought so hard to win. You've just executed the perfect strategy. You made lenders compete, you negotiated like a pro, and you locked in a rate that's going to save you thousands, maybe even tens of thousands of dollars. You feel that wave of relief wash over you. The hard part is over, right? Now you just coast to the closing table. Wrong. This is, without a doubt, the most dangerous phase of the entire home buying process. This period between your rate lock and closing day is a minefield. Most buyers let their guard down, they celebrate early, and they make one of a handful of critical mistakes that can either blow up their interest rate or kill the deal entirely. The lender isn't your friend who's happy for you. They are a risk assessment machine that is running until the very second the funds are wired. Your job isn't over. Your job now is to become a ghost. You need to be financially invisible. You need to change nothing. Let's walk through the traps one by one, so you can sidestep them like a pro. The first and most common deal killer is what I call the credit catastrophe. You've got your great rate locked in, you're excited about the new house, and what's the first thing you think about? Furniture. Appliances. A new big screen TV for the living room. So you head down to the big box store, and they offer you 0% financing for 24 months. Seems like a no-brainer. You're not even paying interest. So you sign up for the store credit card and charge $5,000 worth of new stuff. You have just committed a cardinal sin of home buying. What you don't realize is that your lender, just days or even hours before closing, is going to run your credit one last time. It's called a credit refresh or a soft pull. They are looking for one thing: did anything change? When they see that new inquiry from the furniture store and that new $5,000 debt, alarms go off in the underwriting department. Why? 2 reasons. First, that new credit card application dings your credit score. It might only be a few points, but if you were on the borderline for a certain rate tier, that small drop could be enough to disqualify you from the rate you locked. The lender could legally say, your credit profile has changed, therefore the terms we offered are no longer valid. Your new rate is 0.25% higher. And because you're just days from closing, you have no leverage. You either accept it or your entire home purchase falls apart. Second, and even more importantly, it changes your debt-to-income ratio, or DTI. The lender approved you based on a very precise calculation of your monthly income versus your monthly debt payments. That new furniture payment, even if it's only $100 a month, just threw that calculation out of whack. If your DTI was already near the maximum limit the lender allows, that one small purchase could be enough to push you over the edge, and they could deny the loan entirely. I have seen this happen. I've seen families with the moving truck literally booked, only to get a call that their loan was denied because they bought a new refrigerator. So rule number 1 of being a financial ghost: do not apply for any new credit. No cars, no credit cards, no personal loans. Nothing. Don't even co-sign for someone else. Don't increase the balances on your existing cards. And for goodness sake, do not miss a single payment on any of your existing debts. Pay everything on time or even early. Keep your credit profile frozen in carbonite until after the keys are in your hand. The second trap is the employment upheaval. Let's say 2 weeks before closing, you get an incredible job offer. It's a promotion, a $20,000 raise, and a better title. It's a dream come true. Your first instinct is to accept it immediately. You should absolutely wait. Do not change jobs in the middle of a mortgage application. To a lender, stability is everything. They approved you based on your current job, your current income stream, and your history with your current employer. When you change jobs, even for a higher salary, you introduce a massive question mark into their equation. You're now in a probationary period at a new company. The income, while promised, is not yet proven with pay stubs. To an underwriter, a brand new job is riskier than a stable job you've had for 5 years, even if the new one pays more. Lenders will do a final verification of employment right before closing. They will call your HR department. If that HR department says, "Oh, they no longer work here," your loan will come to a screeching halt. The entire underwriting process has to start all over again with your new income. This can cause delays that might make you miss your closing date, potentially putting your earnest money at risk. And in a worst-case scenario, if the new income structure is different, Maybe you went from a W-2 salary to a commission-based or self-employed role. The lender might just deny the loan outright. So, if you get that dream job offer, tell them you'd love to accept, but your start date needs to be after your scheduled closing date. Celebrate your new job in your new house. The third silent deal killer is the mystery money. You need to show the lender you have enough cash for the down payment and closing costs. Let's say your parents graciously gift you $10,000 to help out. So they hand you cash or a check, and you deposit it into your bank account. You have just created a huge red flag for the underwriter. Lenders are required by federal law, including the Patriot Act, to source every single large, non-payroll deposit. They need to prove that the money for your down payment didn't come from an illegal source or an undisclosed loan. That $10,000 deposit is a giant question mark they are legally obligated to solve. They will halt your application and demand a paper trail. Where did that money come from? You can't just say, "It was a gift." You will need a formal gift letter signed by your parents, stating that the money is a true gift and not a loan that needs to be repaid. You will also need a copy of their bank statement showing the money leaving their account. It feels invasive, but it's non-negotiable. This applies to any large cash deposit. If you've been saving cash under your mattress, you needed to have deposited that into your account months ago, so it could be seasoned. A last-minute, large cash deposit is one of the fastest ways to delay your closing. So be a ghost. Don't move large sums of money around. If you are receiving a gift, tell your loan officer about it up front so you can get the paperwork handled correctly from the very beginning. Okay, you've successfully avoided the pitfalls. You didn't touch your credit, you didn't change your job, and you kept your bank accounts clean. Now comes your final test. At least 3 business days before your scheduled closing, you will receive a critical document called the Closing Disclosure, or CD. This is it. This is the final official breakdown of your loan terms and all the associated fees. Your mission, and you must accept it, is to take your closing disclosure and compare it line by line with the last loan estimate you received when you locked your rate. They should look almost identical. Pay special attention to the interest rate, the loan amount, and the monthly payment. But don't stop there. Scrutinize the closing costs in Section A and B. Has the lender's origination fee suddenly gone up? Are there new junk fees like a processing fee or underwriting fee that wasn't on the loan estimate? Sometimes third-party fees like the appraisal or title insurance can change slightly, and that's often legitimate. But the fees controlled directly by the lender should not have changed. If you find a discrepancy, any discrepancy, you need to call your loan officer immediately. Ask them to explain the change. If their explanation sounds like double talk, don't be afraid to challenge it. You have the right to a corrected disclosure. This 3-day window is your last chance to catch any last-minute bait-and-switch tactics. It's your final opportunity to defend the incredible deal you fought so hard to secure. You've navigated the minefield, you've scrutinized the final numbers, and you're at the closing table, pen in hand. But even after you sign, there's one final step most homeowners forget that can save them tens of thousands of dollars over the life of their loan. And that's exactly what we're covering in the final part of this series. This final step is called mortgage refinancing. And I know what some of you might be thinking. Refinancing? Isn't that what you do when you get a bad deal the first time? That's the single biggest, most expensive myth in homeownership. Getting your first mortgage isn't the end of the game. It's just round one. You fought hard, you used every strategy we've talked about in this series, and you secured the best possible loan for who you were and what the market was on that specific day. But you will change. The market will change. And your mortgage should change with you. Think of your initial mortgage as a snapshot in time. Your credit score was at a certain level, interest rates were at a certain point, and your home's value was a specific number. The moment you walk out of that closing office, the clock starts ticking and all of those variables begin to shift. The true master of the mortgage game isn't the person who gets the lowest rate on day one. It's the person who manages their mortgage like an active investment over the next 5, 10, or 30 years. Refinancing is your single most powerful tool to do that. It's the strategic move that separates the average homeowner from the one who builds serious wealth. So, the critical question isn't if you should refinance, but when. There are 4 main triggers you need to be constantly watching for. The first and most obvious is a significant drop in market interest rates. The old rule of thumb was to consider refinancing if rates dropped by a full 2%. In today's world, that's ancient history. A more modern benchmark is to start paying close attention when you see rates drop by as little as 0.75% to 1% below your current rate. If you have a 7% mortgage and you see lenders advertising rates in the high fives, that's your signal. It's time to pick up the phone and run the numbers. This is the market giving you a gift. Your only job is to be aware enough to accept it. The second trigger is one you have complete control over. A major improvement in your credit score. Maybe when you bought your house, your FICO score was a 680. You got a decent loan, but you knew you were leaving some money on the table. But over the next 18 to 24 months, you're diligent. You pay every bill on time. You pay down your credit card debt. You don't open any unnecessary new accounts. Suddenly, your score is a 760. To a lender, you are a completely different borrower. You've gone from a medium risk to a top-tier prime candidate. That jump from a 680 to a 760 could easily translate into a 0.5% or even a full percent drop in the interest rate you qualify for, completely independent of what the overall market is doing. Don't wait for the market to change. Force the change yourself by becoming a better borrower. This is you cashing in on your own hard work and financial discipline. The third trigger is a substantial increase in your home's equity. This is especially critical if you put down less than 20% on your original loan and are paying private mortgage insurance, or PMI. That PMI payment is just insurance for the lender, and it does absolutely nothing for you, except drain your bank account every single month. The moment your loan-to-value ratio hits 80%, meaning you owe 80% of what your home is now worth, you have an opportunity. You can refinance into a new loan that does not require PMI. On a $400,000 loan, getting rid of PMI could save you anywhere from $100 to $300 a month. That's thousands of dollars a year. You build equity in two ways: by paying down your principal balance every month, and through home price appreciation. If your neighborhood has seen home values climb, you might be sitting on this opportunity right now and not even know it. The fourth and final trigger is a change in your own financial life or goals. Your 30-year fixed-rate mortgage was perfect when you were just starting out. But now you've gotten a promotion, your income has increased, and you're looking to get aggressive with your finances. You can refinance from a 30-year term to a 15-year term. Yes, your monthly payment will go up, but your interest rate will drop significantly, and you will pay off your house 15 years earlier, saving you an astronomical amount in interest, often over $100,000. Conversely, maybe you want to do a major home renovation or pay for a child's college education. A cash-out refinance allows you to tap into your home's equity, borrowing against it at a much lower interest rate than a personal loan or credit card. Your mortgage is not a static ball and chain. It's a flexible financial instrument you can and should adjust as your life evolves. So, when one of these triggers goes off, what do? The process is almost identical to what you did to get your first loan, only this time you're the seasoned veteran. You start with a financial checkup, pull your latest credit report and score, and get a rough estimate of your home's current value to calculate your equity. Then you rerun the playbook from this series. You don't just call the bank that currently holds your mortgage. You shop around with at least 3 to 5 different lenders, credit unions, mortgage brokers, online lenders. You get official loan estimates from your top contenders and compare them line by line, focusing on that APR. But here is the single most important calculation in all of refinancing: the break-even point. Refinancing is not free. You'll have closing costs just like you did the first time. They can range from 2 to 5% of the new loan amount. The break-even calculation tells you exactly how many months it will take for your monthly savings to pay back those closing costs. It's simple division. Let's say your closing costs are $6,000, and your new refinanced loan will save you $300 a month compared to your old loan. You divide $6,000 by $300, and you get 20. Your break-even point is 20 months. This means that after 20 months, you've officially paid off the cost of the refinance, and every single dollar you save from month 21 onwards is pure profit in your pocket. If you plan to stay in the home for at least 20 months, this is a brilliant financial move. If you think you might sell in a year, you'd lose money. This simple math removes all emotion and tells you with cold, hard certainty whether the refinance is a good deal. Now, as you navigate this, you have to avoid a few critical traps. The most common is accidentally extending the life of your loan. Let's say you've been paying your 30-year mortgage for 7 years. You have 23 years left. If you refinance into a new 30-year loan to get a lower monthly payment, you've just reset the clock. You're now on the hook for 37 years of total payments. Even with a lower rate, you could end up paying more in total interest over that much longer period. The smart move is to match your new loan's term to your remaining term, or go shorter. If you have 23 years left, Refinance into a 20-year or even a 15-year loan. Your payment might be slightly higher than a new 30-year, but you'll build equity faster and be debt-free sooner. The second trap is the no-cost refinance. Let me be clear. There is no such thing. A no-cost refinance is a marketing gimmick. The closing costs don't magically disappear. They are either rolled into your principal loan balance, meaning you're paying interest on them for years, or the lender gives you a slightly higher interest rate to cover the costs themselves. Always ask for a breakdown. Sometimes it can make sense, but you need to go in with your eyes open, knowing that one way or another you are paying for it. The entire journey of securing the lowest interest rate isn't a one-time event. It's a mindset. It's about shifting your perspective from being a passive debtor to an active manager of your largest liability. You've learned how to build your credit, how to save, how to shop lenders, how to decipher the paperwork, and how to negotiate. You've done the hard work to get the keys to your home. But the final, most enduring lesson is this: your work isn't over. By monitoring the market, your credit, and your equity, you empower yourself to seize opportunities as they arise, continually optimizing your loan and turning what is most people's biggest expense into your greatest wealth-building tool. This is how you truly win the game, not just on closing day but for decades to come.